Live streaming is on.
All right. Good afternoon, everybody. We're just about in the lunch hour here on the East Coast, and we are about to fire up the latest segment of the Sentiment and Flow Show. And without any further ado, I'd like to introduce Brett Manning, chart trader, of course. Always a pleasure to be speaking with him about the markets and getting his insights. So, Brett, how are you doing today?
I'm doing good, Gavin. How are you?
I can't complain. Can't complain. I got caught up in a short that we'll get into here in a second. So a little disappointed with that as the market's kind of throwing me for a loop with how aggressive it's been with on the bull side. But I figured we'd start this September segment of the Sentiment and Flow show by just recapping yesterday's action in the Fed. We've got our hold on. Let me just grab control of the charts here. All right. So, first off, I have a slide on some of the Fed takeaways, and these are my slides. So, I've spoken a little bit about this, Brett. But what was your takeaways from the Fed? I know people want to hear that from you.
No, I mean I agreed with basically the bullets you put there. I think that one of the most important lessons that I've learned over time is it's it's often possible to have many different interpretations of the Fed,
Right.
and it's sometimes very interesting to see which one the market runs with. And that was the purpose of my morning note this morning. I think it's extra difficult this time around to look at the market today and make the assumption that it's reflecting judgment about what the Fed did yesterday, because it could just as easily be about the fact that there's not going to be a government shutdown for at least until the end of October now, or that there's possibly a restructuring agreement that's really coming together and getting teeth in China where Evergrande is concerned. There's so many different important wheels spinning right now for the market on a macro level that it's possible that people were worried about a really hawkish Fed, and they only got a little bit hawkish Fed, and this buying is really because they were waiting to buy um, the Evergrande restructuring idea or whatever, and they needed the Fed just to get out of the way rather than seeing this as a response to the Fed. Or perhaps this is a response to the Fed. It's just when there are
You,
so many
the,
different, really significant macro factors, all macro balls in the air being juggled at the same time, it's easy, I think, to look at, here somebody said this, and then the market does that, and think that there's a direct causal relationship when there may not be.
Right, but part of this, you think that there could potentially be the idea, and I know you spoke about it in our last Sentiment and Flow show, that people could be concerned about a policy misstep if they were
Absolutely.
under the perception that the Fed was going to be moving too quickly. Now, with that in mind, Brett, did you have any takeaways in terms of when they stated that they could be moving possibly in the next meeting? Um, that the jobs number didn't necessarily have to be a complete blowout figure in order for the Fed to
Hmm.
move, or anything along those lines, or even the fact that he kind of laid out that they expect to end the program, the bond purchase and MBS purchase program by the middle of next year. Any of those jump out to you, or do you think that that was generally in line?
So I think that if you step back, this is all a little bit absurd to have such drama around this for the market. I mean, we're dissecting things as a marketplace of market participants and analysts and a Wall Street community. I think a little bit to an absurd extent, because if you had sat back, months ago and just said what's probably going to happen, what's probably going to happen that the Fed's going to taper sometime toward the end of the year, be done with it about the middle of next year, and then by the end of next year there may be a hike on the table, or it may be a little bit in the following year. That's what the Fed funds futures showed. That's what the Eurodollar futures forward curve showed. And all along the way, that's been what everybody assumes anyways. And for some reason, there's this big drama about when Powell's actually going to say the word taper.
Right?
It's just
Yeah.
it's a bit ridiculous, and I think that some of the reaction could just be kind of people realizing that that's ridiculous. This is of course what's going to happen. This is of course what we've been moving toward as a base case for just about everybody on the planet. Something like this.
Right. Yeah. No, I know I had a couple of discussions yesterday about people asking when they thought that Powell was going to be announcing it. And, is this a rally because he didn't announce it today? And I don't think anything really changed, like he said, in terms of the narrative. Uh, everyone is expecting the Fed to maybe start moving in December, January, whatever it might be.
Hmm.
But the exact date, I don't think really kind of matters as much
Well, yeah, why does
as
it really
much as the
matter?
general vicinity. I suppose I would say this, maybe the one time that we would want to keep a close eye on that is when the Fed does announce that it's starting to taper. The first set of big bond issuance that we have out there, does that impact the demand for it? I guess would be the one thing, but it might increase the demand too, right? If people are of the idea that they don't have to bid against the Fed for them.
Well, I'll tell you what; those are one-off dynamics either way. The problems happen when there is a unassumed extrapolation of a long-term future course that has to change dramatically, and nobody's going to be caught in that situation, regardless of whether it's November, December, or January, because there's maybe going to be one more month of bond buying at the same level, or maybe not, but it's not going to change any larger process or any major positioning thesis.
Okay, and with that in mind, Brett, the dot plots, they obviously got a little bit more hawkish, relatively speaking. This is off a uber dovish level. So I figured it would be interesting to kind of juxtapose what we have in rate height expectations from the latest Fund Manager Survey, which of course was taken last week ahead of this Fed, and taking a look at those numbers. I think everything pretty much lines up with with what people expect, but is there anything that was jumping out to you in terms of the dot plots compared to this rate hike expectation survey from Bank of America?
No, I mean, so last time we said this is gradually going to work its way toward agreeing with the euro dollar futures forward curve, which was you're going to see a rate hike in you know December basically of 2022, and that's been the call by the market by and large since I think uh, February or January of this year, and it really hasn't changed. And the idea is over time, when there's a confirmed kind of bias like that in a market-driven expectation for the Fed, and it's far enough out in time, usually you see the Fed members gravitate toward agreeing with what the market has already put in place, and I think that's what we're seeing most likely right now. The title of this chart kind of bugs me a little bit because clearly investors expect the Fed to hike rates in the second half of 2022.
Right.
But yeah, I think there are a lot of
Which is
small
in line with
errors
the
in
dot.
this.
Although I do expect to see an uptick in for the second half 2022 and first half 2022, the next time this survey comes out, like perhaps the first half 2022 outpaces second half 2023 next time around. That
First
probably
half of
well,
2022
yeah. I think
for a
that we
hike?
could for a hike. Yeah,
You
I
think we're
think
going
that
to get a
we'll
hike
see.
before June of next year?
Oh, I'm saying I don't think so. I think that the market has it, or that the survey participants have it right. At least the majority of them with the second half 2022 or first half 2023. I'm
Okay.
saying I think that you're going to see a little bit of a pull forward in expectations on when the Fed could possibly move.
Because you think you're going to see an uptick in inflation, or what's the?
Yeah, but certainly the inflation aspect of it. I mean, we'll continue to see, and we'll go through these charts, and certainly the Fed's winning the hearts and minds of investors. I would
Right.
say with the transitory argument, we'll see that played out in some of the slides we're going to show coming up here.
And of
But
course, let me point out that if you people who make that assumption, if there's a growing number of them, they would also be assuming an accelerated taper rate,
yeah, no, that's very
more
true.
being taken out of the bond purchases on a monthly basis
Yeah,
faster.
because the Fed's definitely been pretty clear. Powell and company have been clear that that rates and tapering are two totally separate animals in
Yeah,
terms
and
of
you got to eat your greens before you get to eat your dessert.
exactly. So, but and obviously inflation, the one concern that's out there. But we'll see what happens as we work our way through the some of the supply chain issues for sure. So, Brett, let me then just run the 10-year by you and ask your thoughts on the 10-year. It's obviously had a pretty strong day. This is one of the reasons why I went after the NASDAQ. I thought we could see the NASDAQ fall out. Now, the 10-year is up about 9 basis points on the session, and I've been showing this daily chart. And I know the 200-day doesn't necessarily play in when you're talking about rates and everything. It's just kind of a nice level, but it's certainly breaking the downward trend line that had been in place over the last couple of weeks or last couple of months, going back to earlier in the summer. Do you have any thoughts on the 10-year, and is there any levels that you are kind of red flagging there? Or do you think if we just continue to see a nice steady raise today, excluded, that the market would be perfectly content with this?
Well, one thing I point out is you're looking at the 10-year, but 5 years up even more. The whole curve is up. This isn't a steepener. This is just, this is
Across the board.
it's just, I guess the hike being priced in a little earlier. I mean, it's just the whole thing's bumping up, and really a misdirection and really a malpositioning off of yesterday's initial reaction. If you look at we've got a whole massive bull trap. If you look at the TLT, like it ripped into the close and then gapped down below the low and dove. So there's a kind of an offsides element happening here. A lot
You're
of people.
not still short the TLT, are you?
No.
Okay.
I mean, I had my stop at 151. I got stopped out last week, I think. But yeah, I mean, it was a Titan stop up near the entry, and I'd already taken some off the table, so it wasn't a problem. But it wasn't, it never really took off in the direction I was looking for. And I think yesterday into the close, we got a squeeze from bond shorts, and we squeezed them out, and then probably sucked in some people looking for a flattener, and everything just shifted this morning, and the market has an entirely different take. And now it's just risk on, because I mean, you look at junk bonds are rallying. Everything is basically moving toward. So in other words, credit spreads are tightening as the rates move higher, and the rates are moving higher across the curve. So it's not a steepener. It's a policy shift on sound economic prospects for in a textbook explanation.
Yeah. All right. Let's take a look then at some of these other slides, Brett, unless there's anything else with regards to the Fed that you wanted to address.
Anything else that I want to address?
Yeah.
Yeah, I mean, no, I think
with the
it was.
Fed.
Yeah, no, right. I got you. It was interesting to see the dot plot pull to 9 to 9. So we no longer have our magnificent 7. It'll be interesting to try to ferret out who the other two were that shifted. And it's interesting to see we've got people looking for a series of rate hikes by the middle of 2023 if you kind of extrapolate through everything. So there's a hawkish contingency on the Fed that's growing. And if you try to look at, and I would imagine the 9 dots in 2023 probably include all the people with the most significant opinions, right? Powell and his close, kind of in group probably are all in 2023, but there is a growing rebellion. And it's some people looking for, again, 3 or 4 hikes by the middle of 2023, which is there's real hawkishness starting to emerge. And I imagine that some of that has to do with this transitory versus non-transitory debate, and people thinking the worst thing we could do is put ourselves in a position where inflation expectations truly shift. Maybe the wage changes are really sticky, and even if it's painful, we have to do something about it now. That sentiment is growing on the Fed, and it's growing in number, which is important. And there's a little bit of a looming risk there. Especially if there's a change at the top of the Fed or a reorganization of any kind, or that just continues to grow and you start to get dissents. But at this point, everybody's voting in line, and the core group is still kind of on the same transitory plan.
Okay. All right. Not to get sidetracked here, but just keeping an eye out on headlines. And I'll ask you a quick question, Brett, on how you're going to be handling this in your futures trade in the next couple of weeks. But White House asks agencies to prepare just in case government shuts down, but Democrats and Republicans say they intend to fund the government before September 30 deadline, according to the Washington Post. So just wanted to make sure people were aware, because we are seeing a little bit of tiredness in this rally here in the markets, and possibly a rollover that I guarantee people will be pointing to these headlines. Are you concerned at all about these headlines, government shutdown headlines at all, Brett?
Now, I saw something earlier that basically said that they've already found bipartisan agreement to do the continuing resolution, which means the government won't shut down until the end of October at the earliest.
Right.
Didn't you see that? I mean,
Yes. Yeah.
yeah, it's already basically, it will pass. And then they've just got to make sure that you get the debt ceiling raised by the end of October. And then, you know, the next drama passes to early December. But the idea of an imminent one, and maybe this is just the White House putting pressure on people to make sure they stay with that plan.
Yeah, no, I'd agree. So just wanted to get that real time out there. Okay, let's take a look at some of the sentiment data then, Brett, moving forward. AAII, this has been a lot of volatility around it. You can just kind of see just the month of September, the bull levels have been September 1st, 43%. The 8th, it dropped to 38. The 15th, it had cratered to 22%. And the bulls are back up to 29% here. A lot of this has been flipping into the bearish and neutral categories, obviously, but we want to take a look here at the AAII bulls chart.
Hold on one second. So let me comment on this chart
Sure.
while you got it up. Just
No problem.
notice that the 22% is the lowest number you see in the first column, anywhere down, and it actually goes way back further than that.
Yeah,
As lowest. And also
I think it
the
was like
bearish,
2018 or something like that. I believe.
the bearish has two 39% in a row. Those are the highest that you see going anywhere back, and they actually go further back as well. So this is emblematic of a shift that's happened in the last few weeks. And actually, in our last flow show, we talked about this starting to develop. And so one of the points was basically the market, perhaps there's going to be some, macro hiccup that we're going to hit, but shorting the market where it was or here or anywhere on the basis solely of too much exuberance is becoming a false bet. And so you're seeing people get their butts handed to them today trying to fade this rally because we're in a situation where everybody was already carrying a lot of hedges. And that's reflected in this data.
Right. And I'd be one of those people with tire tracks on my back there, Brett. So the AAII bulls chart, this is a 3-year look at it. Obviously, it's remained relatively elevated for the last couple months, upward trend. What's your thoughts here on this AAII bulls chart?
Well, I think it's interesting to see it go back down into the zone we were at basically immediately following the March crash of 2020. Like you can see, we had picked out of that sentiment area, right? So we got the March crash, and you had spent we an exhaustive amount of time during the rally out of that crash telling people not to short because we were seeing the market rally on continued extremely bearish sentiment for a while, and it makes it really, really difficult. And everybody wanted to short, picking your levels all the way up from that summer rally when we were seeing cases mount back up. We're seeing shutdowns we talked about again, and it was just so easy to feel like, well, this is a shortable bounce out of that initial crash. But when you look at the sentiment data, it was just not a viable position. Well, guess what? We dipped right back down into the same range, at least on a one-off basis. To say that the survey, I want to see it faster for a few weeks. This is a one-off right now because it's already back to 29. But you're wondering if people snapped into a bearish mode based on what we've seen over the last couple of weeks, and this is confirmation that we snapped all the way down to, at least in this measure, all the way down to a place that we were during the few months that followed the initial March crash of 2020.
Right. So the basic gist being that sentiment really is, and we've seen this is obviously doesn't even include today's data because otherwise you'd have that bounce back to 29 on that chart. But it's definitely reflective in the price action we've seen over the last couple of days where everybody had gone bearish and now you're seeing everybody starting to buy, and that's kind of running things up here. So
It's another reason why bonds are acting the way they are today too, if you want to reflect back on that conversation, because there was probably a whole lot of money parked there. It was parked there on the basis of, a safety bid if there was some kind of debt contagion from Evergrande or whatever. So that's also helping that 10-year rise.
Okay, we'll take a look at that in a second here, but first we want to take a look at that SPY liquidity premium, Brett. We talk about this a lot around times of volatility, where people see the indices more as a safe haven rather than picking stocks in certain aspects. They want to still be involved in a passive manner, and we've seen an uptick in the SPY liquidity premium. So, are you expecting this to revert a little bit more to the middle of the chart, based on the price action we've been seeing?
I'll tell you what, when it does, it's going to be an important signal to watch, because so what this really means is there's a lot of people who want to be involved in the market. There's a lot of volatility. Volatility is a great thing because you can make a lot really fast, but you can also lose a lot really fast. And if you trade individual equities, particularly mid caps and small caps, if there is some serious headline that comes out of the blue. So when you got these sort of macro dramas happening. So the Evergrande situation is a perfect example. Let's say a few minutes from now, there was an announcement that came out from China basically saying they weren't going to bail anything out. There's a ton of international exposure, and they're really more worried about moral hazard than anything else. And this is going to be just a straight up $305 billion default. And there actually is a lot of exposure that we didn't realize, and major European and US banks and whatever. Obviously, it's not true. I'm just coming up with a fictional example of the type of headline that could happen in a kind of macro drama situation where you could freeze up a lot of stocks. You could see the S&P gap down 2% in a heartbeat. You could see something crazy happen. It's like a landmine going off. Just walking across a field, you step on it, boom. So when there is an environment where it's possible to produce moments like that, and people are aware that that risk is there, and when there is volatility around that risk itself, you tend to see this measure pick up, because this measure basically is, I want to be involved in the market, but I want to know that if I have to get out and get into cash at a moment's notice, I can do it. And an ETF like the SPY, you're guaranteed of that. There's always going to be liquidity on both sides of the tape. But if you're in a mid-cap stock, there's no guarantees at all. You could hit sell and there's just no bid whatsoever, if there's a big headline. So this is a measure of people, especially people with large capital trying to trade large positions. They're flocking to, they're concentrating all of their trading activity in the most liquid possible version of the equities market, which is really the futures and the major index ETFs, rather than in the individual stocks. So this measure is a liquidity ratio between the individual stocks in the S&P 500 versus the ETF that represents the whole group. So when the liquidity shifts toward all the trading just in the ETF and not that much is in the individual stocks, it moves above that green line, and that's where it is now. So that's what it's showing us is what's happening. And you could see, look at March of 2020, you see the crash, and look at where this thing moved. Virtually all of the trading was in the index level rather than in the individual stocks making up the index. And that is simply because people want to know there's an exit door they can get to if they need to at a moment's notice. So
Right.
when you see this, it tends to be during times that are actually good buying opportunities, except it's not a perfect timing instrument. And if we see this drop back down, as you suggested, it means people are starting to feel like we're past the big risks.
Right, and we'll get into the risk segment here in a little bit. But next chart we want to talk about is the Inverse Etf Volume here, Brett. And again, this is another measure of risk for the overall market sentiment. So what was jumping out to you on the Inverse ETF?
So I wanted to highlight this because we've got such a problem tracking some of these options ratios now, and we've discussed this because there's a whole new class of investor in this market that uses exclusively options. So the traditional historical comparisons are kind of muddled into apples and oranges. But this is an easy one to look at and just say, this is bears, this is hedging. And when you see this spike up, it's almost always at a point where a lot of people are starting to bet against the market for one reason or another, or at least to, inverse ETFs are an easy way to hedge, especially in 401ks where you can't take shorts. Or you got like a Roth account or something. They don't let you short, but you can buy the inverse SPY, and people tend to do that. So when you see the spike up, it's just another measure showing you simply what we saw in the AAII bulls chart. This is the same spike. It's just the other direction because this is participation in inverse ETFs. It's just another demonstration of how much hedging, how much bearishness we built up very quickly over the last couple of weeks.
All right, and then Next up, we're going to push into the Bank of America Fund Manager Survey here, Brett. I put together a couple of bullet points, and we'll kind of cover each one of them. But definitely, we saw a lot of the macro optimism continuing to slide. A lot of the ideas of, and we've seen it in the PMI surveys today, that peak selling that people are concerned that we've moved past, and we'll get into a little bit deeper on that. But it's obvious because expectations for global growth have slowed to 13% now. This was the lowest since May 2020 and down from 75% in June. So that's a pretty steep decline over the time frame, and we've seen similar activity in the PMIs, probably not to this extreme. With that, of course, expectations for rising profits dropped to 12% compared to 89% in March 2021. A lot of that also has to do, of course, with the income and inflation and cost of goods sold pops that we're seeing here. We'll also talk a little bit about the taper, which was at 84%, expecting us to taper by year end. Now, this is the same as August, and
which is interesting, right?
which is interesting because
Given everything you just said a moment ago, yeah.
Exactly. And it's funny. There's a couple of survey respondents here, and we'll get into the inflation one in a little bit later. That doesn't make a lot of sense. 59% of people see monetary policy as too stimulative, which is the most since May of 2011.
Right. And that was the
Which,
time. Yeah. Right.
yeah, I mean, we're going over a decade since people have felt that the Fed's doing too much. Positioning in small cap value and junk is back to pre-election lows.
And I would just
And
point out, though, in May 2011 was just before Europe went back into recession.
right,
So, yeah.
correct. And then the other thing too is we just mentioned no mention of Evergrande whatsoever in this report. However, when we go through, there might be one area where it's suggesting Evergrande, and we'll take a little bit of a closer look at that. But moving into this Bank of America Fund Manager Survey, I know there was a couple of charts that were jumping off the page to you. One, we discussed this in our August meeting, and again, it kind of creeps up, and that's the disconnect between asset prices and fundamentals. So, you want to just kind of read out what we're seeing in this chart and how it translates into your thinking for trading here.
Yeah. So, I mean, I think that this is sort of like we're still overweight equities, but we see the environment deteriorating, and also a stagflation theme, which we'll get into over the next few slides after this. But it's strange, and one wonders whether there's some reporting bias in terms of what these individuals are revealing in terms of their book positioning. But I mean, obviously, it begs the question that are these people all, when they answered the survey, were they just getting ready to start selling? And of course, that was really, this data was collected before we started seeing distribution across 4 straight days and then a crash day. So you can kind of see the possibility that this is signaling that that distribution process.
So what do you think is I mean, obviously I think that the dark blue line, the overweight equities, that's probably the bigger tell, right? Like I mean I feel, and I've kind of been in this situation where I've been talking about
Possible.
how I expect a lot of volatility, a poor Q3 earnings season coming up here, and we've seen it play out in the FedEx earnings report, certainly the home builders, where those supply chain issues are coming home to roost. And it behooves a company to remain conservative and set low expectations and then outpace them, rather than set those high expectations that are unreachable.
Absolutely.
And I kind of feel like that's reflected in this survey, where people are answering that, expecting a stronger economy aspect on a little bit more of a shorter term basis than they should be, is kind of how I'm looking at that. So I feel like that they're like, yeah, everything's horrible, but I'm not selling anything. And that's kind of the bigger tell for me. I'm guilty of that. I mean, but like I said, I haven't sold anything in my portfolios. I've taken some profits here and there on some winning positions, but I've been trying to
I
short
get you.
the markets to hedge it.
Right.
And I
I,
feel like that's kind of played out in this chart.
I get you. And you know what? This will go into a class of analytic ideas that I have, that I think about sort of the life cycle of a bull market, there are a few things that if you step back and you think about what must be the case in a long-standing bull market, and I think you can kind of take March out of the picture. Last year, I think of this still as sort of a 12-year-long bull market we're in. And I would say there's a couple of things that you know to be the case. And one of them, for instance, is here, and I think this is a really interesting way to think about things. What happens over the course of a 12-year bull market in terms of who controls the largest amount of capital? And it turns out to be that people who, no matter what, on every pullback, no matter why it happens, plow money into stocks, right? Because just obviously they're going to do the best in a long-standing bull market. It doesn't necessarily mean that they're the best analysts or they're right. That's just an instinct. There are people who just operate that way. They just simply see a pullback and they plow money into it. And they're going to come to control a larger and larger amount of capital until you finally get a bear. And then they're going to get run over because they're going to buy into the first pullback and then get slammed, right? That's something you can sort of deduce. And I think that, so that's a sort of macroscopic way to analyze the changing population on Wall Street and the flow of capital. Assets are going to flow to people who have that instinct, not because people know that's the instinct they have, just because they've been outperforming like crazy for a few years because it's a bull market and they're just well aligned with the bull market environment, but they haven't been tested by the type of bear market that maybe lasts for more than a month or two, where there really needs to be some better defensive strategies going on because you get bit so hard that really, you get so behind relative to your competition who's able to hedge better. Then the decision of where to flow capital becomes a little bit more nuanced. But in a long-standing bull market where every pullback is bought back up, the capital is going to flow to people who just have that instinct just by dint of performance. But then the same thing happens, I think, inside of people along the way. Money managers have been through this bull market for a long time now. They've had lots of instances of feeling bearish. And every time they decided to massively reduce their positioning, it hurt them.
You paid for it, yeah.
Yeah, and it's just, I think it's muscle memory. It makes they just simply, I don't think things are going to work out, but man, I've been there before. And it always worked out best if I just didn't touch anything.
When you look at this chart and we talk about just the prior chart that we were talking about with the SPY liquidity premium, do you think that maybe it's just a move back into a little bit more passive investing?
I think it's more active participants that are causing that chart. So it's the trading.
Okay.
People who are really active in the market, they're going to be trading stocks in and out, or they're going to be trading futures in and out.
Yeah, I would think if they're active, that this blue overweight equities would have been a little bit more aggressive to the downside then.
Well, no, I don't think this is the active people. I'm saying the SPY liquidity premium is showing.
Okay. Yeah.
This is not. This is not at all. This is showing lower rotation for sure.
Yeah. Okay. No, that makes complete sense.
So, and you can see in every one of these instances, the light blue line leads to the downside. Right. So they wait. I'm not going to get out of my overweight position until I really know things are rotten.
Until Evergrande really is a global contagion or something.
Because every time I felt this way, but the market wasn't down, I paid for selling.
Yeah. All right. Let's take a look.
That bonus got chopped down.
Yeah, right. Okay, so and we can see this being reflected, of course, in the profit expectation dive, and you could just see March 21, that peak selling. And we saw a couple of mentions of that in the PMI reports. Brett, I don't know if you had a chance to take a look at my comment this morning. I posted some of the things that were jumping out on the European and U.S. ones, and the continued decline and the acceleration of decline. Because of a lot high, certainly the supply chain disruptions, and yes, there's just simply not enough materials out there to build the products.
Getting squeezed.
Yeah, and now as we could see, this profit expectations at the lowest level since May 2020. It peaked at 89% in March 2021. The one thing that is of interest to me, Brett, and I've seen this a lot. I saw it in the beige book, in the PMI numbers. You could see it like when FedEx talks about them raising their rates by 5.6%. The pass along to the consumer. I'm starting to see that a lot more, and I'm really interested to see what the end is. But what's your thoughts on this profit expectation chart. And how do you approach Q3 earnings season coming up with this in mind?
Well, so I think it's the first of the charts in the next series of charts that show what I think is a growing expectation among large portfolio managers, possibly very wrongly, of protecting against a stagflationary environment. So there's a series of charts here that all basically, in other words, the Fed's still going to taper, inflation's still going to be there, but companies are going to be making less and economic growth is going to be slower. And that's basically the definition of stagflation. And there's even one with stagflation in the title. But here's the participants in this survey look to be leaning toward the possibility of things turning more stagflationary, generally speaking. But yeah, I mean, obviously, if so, this upcoming quarter earnings season really, comes down to whether all this stuff is really transitory or not, because people aren't going to punish companies for having a one-off quarter problem when this is, when there's a bunch of transitory elements that are at their most intense. But they're all going to be going away, a month or two later. But if you feel like this is going to be really set in, hey, we're going to pass along those prices to the consumer, and the consumer is going to have a job somewhere, and they're going to demand higher wages, and the Fed is going to keep the liquidity flowing, and those higher wages are going to be paid, and it's a cycle. And then you've got increasing inflation expectations. Then people start to behave differently. When a price goes up for something, instead of saying, I'll wait for the price to come back down, if they just think it's going to be twice as high a month later, they're going to buy it at the higher price. So you start to get velocity increasing at the same time. And if the Fed leaves the spigot open while all that's happening, then boom, you've got a real inflation problem. And that's how it can metastasize from here. If it's all about what people think, the price is going to be the next day. And if it's going to come back down because there's just a supply shortage, no big deal. But if they really believe it's just going to keep going up, and this is the cheapest they're going to find it, they're going to buy it. And they're going to demand higher wages to be able to afford the cost of living. And if there's a labor shortage at the same time, employers got to give it to them, and then we've got this cycle that's starting up. And if the Fed keeps the supply of money really, really high, then that allows that beast to grow. So if those expectations at this point, from what we can tell, the expectations have not shifted. You look at something like the volume of auto sales. Auto sales have gone through the roof. What happened? People stopped buying cars. So that
Right.
shows you, right, that's a healthy sign,
Yeah.
because they're not saying, well, the car is going to be 10 times as expensive in a year, I better buy it now. If and when that shift happens, that's going to be a real problem.
Yeah, and then you get people caught with inventory and everything. So that's going to be a key thing. Watching inventory levels in the Q3 earnings season. It's one of the reasons why Stitch Fix was a little nerve-wracking for me, but that short squeeze was taken over. Margin expectations, kind of just a build off of what we saw with the profits, obviously. Here, Brett, net 22% expect margins to decrease, which, as you can see, it's the first time that we've seen this decrease in a while. We've seen that reflected in the earnings report, and we were just kind of talking about it there, and the PMI commentary.
And
So,
now let me just interject real quick. So when
sure.
we're looking at these charts, guys, remember, this is just people's opinions. This doesn't
Yeah,
mean that this is what's going to happen. It's interesting to see that this is what people are expecting, because they could be dead wrong. And
right. And
that's
it does,
possibly the opportunity.
and it lowers the barrier of expectations for earnings, which is
Exactly.
something we
You could have
haven't
some
had for a
great
while.
results relative to these expectations.
Yes, exactly. So key to keep that in mind, and whether or not it's priced in as well remains to be seen. All
Mhm.
right. And again, Brett, you were talking about the stagflation. We actually saw stagflation mentioned in one of the questions. It's the peak boom stagflation concerns, which we've been talking about. Now you can see above trend growth and above trend inflation. That's been the dominant theme for a while, but this is why they're talking about peak, because you see that coming down over the last couple of months, and then you see this one below trend growth and above trend inflation, which obviously is the definition of stagflation. Now we had plenty of that going on in 2008, right around that 2011 period. Again, Brett, it came back down, but it's really been benign since then. However, we are starting to see this creep up to the highest levels in about 2 years.
And one thing I
So
want to point out on this chart, though, look at the two big humps back in 2008 and 2011. So of the light blue line. So people have this problem of understanding the impact of things like quantitative easing, especially when we first did it. We're going to money print. Now everybody thinks we're going to have massive above trend inflation. It's not going to do anything for the economy. That's 2008, right? And then we did, what was that, twist probably in 2011.
All of it, yeah.
Or QE2 or whatever it was, this idea that
Right,
there's
to
no
steepen
question
that
that
curve.
the Fed is printing money, therefore we're going to have inflation through the roof. And so each time we do an extreme monetary policy kind of step, there is this kind of instinctive reaction to assume that by people on Wall Street, not necessarily in the general economy, that this is going to guarantee some kind of stagflationary outcome. And so far, it hasn't happened in the past. I wouldn't be surprised if that's playing into things a little bit here.
Yeah. All right. So obviously something nobody likes to see the term stagflation, but I would warn that we are far off from that at the moment. And then again, inflation expected to cool, which is interesting because this definitely helps with the Fed transitory inflation argument here. And you can see where we were at April 21, and then a drop down here in inflation expectations, at least on this expecting to cool. Now, this is the inflation expected to fall for the first time since May of 2020. Obviously, we're just coming out from the pandemic there, and everything was a pretty negative sentiment. So it's interesting to see this drop off, despite all you see is concerns about inflation in the headlines, right, Brett?
Yeah, however, I would say that there could be a technicality here in that the question likely appears to have been
A year over year.
well, or just will it go up or down in the next report or whatever. I mean,
Okay.
even if it goes down a little, it's still going to be an annual 5%.
Right.
So you can hold the view that it's going to go from 5.3% to 5%, and still this would then square up. That you think this is really just is the next tick going to be down or up?
Okay.
But it still may be at a high level. It's not receding back to 1.5%.
Yeah. So just from the elevated levels. But again, we talk about the transitory argument, and that is moving up where now we have a net 69% of investors think inflation is going to be transitory. So obviously, the reports over the last couple of weeks with the PCE, hourly earnings, and everything have suggested this. But it's funny because the sentiment data doesn't necessarily suggest this. So you think this is just a matter of fears being kind of overblown and the hard data brushing aside some of those fears, and therefore the transitory is kind of winning the day?
I think probably the last two CP reports are important. And we saw, and if you look in the guts of it, like a lot of the things that were sort of the biggest bad actors dove quickly. And I think that there's a dynamic there, I think, where the idiosyncratic data points in the weeds of the CPI report reacted as if to it was sort of a win to the transitory team in that type of downtick. And I think that probably is directly responsible for the shift in the survey.
All right. And then the tail risks, which is funny because we see that dive, but inflation still is by far the number one tail risk at 24% now. Remember last month when we were looking at it, it was like 22, 19, 18, 17, 16% for these. We've seen inflation uptick a little bit. The taper tantrum downtick has been evident in some of the moves that we've seen today. Downtick in the COVID Delta variant, which has continued to see lower and lower concerns. Asset bubbles also cooling a little bit. China policy fallen down, but geopolitical, that popped in at number 6 here. It's still only 9%. Do you think that could be Evergrande in there, or do you think that could be fiscal policy with the battle going on Capitol Hill?
I would say that it is Taiwan.
Taiwan, okay.
Right, I think that is. I think China's put chess pieces in place to basically
take it over,
nab Taiwan at any time, and the only thing that we could do is start a war over it, and that's
which we might
enormously strategically important.
Yeah, I mean, people are probably like, Taiwan, what do they do? Well, they export the majority of semiconductors out to the world.
Taiwan
Semiconductor is by far the largest. And now
it's like the largest oil producer 100 years ago.
Yeah, exactly. So, there is a lot of tail risk at Taiwan, but I just thought that was interesting that kind of popped up, and inflation rose higher, even though some of the other data points that we're seeing in this doesn't necessarily feel like people think that inflation is running away. So, any thoughts on this tail risk chart?
No, again, I mean, one of the problems I always have with this is the conviction coefficient is difficult to tell. And if
Right.
this is multiple choice, who knows how likely somebody who ended up saying inflation was, just about to say Delta, and who
Yeah.
knows? I mean, I don't really know how, much conviction. I mean, I believe these results make sense to me, because I think even people who don't think there's going to be runaway inflation still would think, well, if they're just like I just explained. So let's say, next month we see those people are buying the cars at the higher prices. So the volume of sales goes up, because it's indicating that people are starting to accept the idea cars are only going to be even more expensive in the future, and
Yeah.
then they're demanding higher wages because they can't afford a car, and the Fed keeps the spigot open, and like that engine can start, like, even if you don't think it's their base case, it still is a big tail risk if you start to see that data, because then again, Fed's got to tighten even if growth is falling, and everything is pretty much a guaranteed recession, I would say.
Yeah. All right. Then another chart. What to do with excess capital? Increased capital spending remains the top one. Improved balance sheets is down in the middle. Increased capital spending surpassed balance sheets a while back. But then the return cash to shareholders, that's been on the rise, trying to break that downward trend. So any thoughts on this particular chart, Brett?
No, I mean, we're just watching that orange line creep up toward,
Yeah, right.
that, like, the sort of cycle indicator idea. When that orange line starts to cross the other two, is
Right, which is also funny when you consider that most are expecting margins to be crimped,
yeah,
um,
right.
which I find it interesting, but kind of a little bit of a disconnect, I thought, with this chart from some of the other things that we were seeing in here. But we'll continue to watch this, and obviously, when you see something flip like we did with the capital spending and balance sheets, it's kind of when you see a change in psyche, I feel, in the markets. All right. The last chart, Brett, that we're going to move on from the fund manager survey, and we're going to talk about Evergrande real quick. And we've been talking about it a lot in our comments the last couple of weeks, and trying to keep it on people's radars, but also downplay the importance. When you look at it in terms of exposure, U.S. banks are very low exposure to a lot of the issues going on in China right now. But for China itself, this is a pretty major issue, considering property makes just about 25% of their GDP. It's definitely something that could be disruptive in the credit markets and the debt markets, of course, which is what we're going to be keeping an eye out on. But one of the things that I thought was interesting, and Miller Tabak had this note out this morning, and the red line, that's the percentage of corporate debt to GDP.
Uh-huh.
And you can see that that's at a very elevated level. And everybody knows that people have been hitting corporate debt markets pretty aggressively. And that, of course, is cause for concern when you start seeing credit conditions potentially tighten when there's an
Uh-huh.
Evergrande situation here. But I think what is notable was this blue line.
Oh yeah.
And that's the amount of the percentage of GDP that interest expenses make up. And that's at a 50-year low.
Yeah.
So right now, we currently have a lot of manageable debt. Of course, Brett, that could switch when the rates start going up, and then you're switching out cheap debt for more expensive debt, and that's something that needs to be monitored. But I think offhand right now, I'm not expecting Evergrande to disrupt the overall markets. I think we've been pretty clear on that. Certainly knocking off a little bit of froth, as we've seen, that's not out of the question. But to think that this is 2007 all over again, I think that you need to be careful of that. And you can kind of see 2007. That's when that blue and red line flipped over, right when the interest expenses were getting a little too high, and you can see that area shaded out. But we're nowhere near that right now, and it's very manageable corporate debt, even with a little bit of fluctuation in the debt markets. So, Brett, any thoughts on this chart, and any thoughts on Evergrande in
Yeah.
general?
Okay. So on this chart, I mean, I think that this is tracking the decline in interest rates over time. The blue line is enabling
Correct.
the red line, but there's a hidden variable here, which is the amount of cash on on balance sheets of companies with a large amount of debt. So if interest rates go down enough, it becomes actually economically advantageous to take out a ton of debt, even if you've got a ton of cash, because it's so cheap to manage the debt that you can make more of an investment from borrowed money. So you keep your cash balance, you borrow more money, you support your stock by buybacks or whatever you want to do, and you invest borrowed money in new projects or whatever you're doing, because return on investment is going to be higher than the really low interest rates that we're building up over the last decade. So you've got a lot of companies on here with that do huge corporate debt rounds, even though they have huge cash balances. So there kind of needs to be a sort of self-liquidating variable to kind of comb through this and take it to a situation where if you have a massive corporate debt bubble and balance sheets are actually cash poor at the same time, then interest rates start to go up, you have a crisis. But that's really not the situation that's built up over the last. I mean, obviously, if interest rates start to go up meaningfully, and there's a lot of paper that needs to be rolled over, then you're going to see a shift in the way that the market works. But that doesn't appear to be, a huge risk right now. And then on
Yeah.
Evergrande, I mean, I wrote this in my notes a few days ago as well. I really tend to believe that this is a situation that's going to tell us something about where China's priorities are in a lot of ways. And China is in a situation where they could simply have priorities that start to diverge from, outward economic dominance to inward cultural dominance.
Control.
And there's
Yeah.
a lot of signs right now, symptoms
That
building
they're
up
on to
that
a turn.
suggest that that's what's happening.
Yeah.
And if that's what's happening, then Evergrande isn't really the problem. It's just a small symptom of a growing thing that's going to become a bigger problem, and we'll just kind of need to keep our eye on that.
Yeah, it's going to be such an interesting case study on whether or not they can manage this down, 300 billion in debt, likely to just kind of be washed away for pennies on the dollar. You're also going to have, how are they going to treat outside investors, and what kind of impact that has for foreign direct investment moving forward. So it's going to be fascinating to watch this Evergrande roll out over the next couple of months.
Now, will we really know the real story ever?
Probably not.
Probably
Right.
not. That's too
I'm
bad,
sure
right?
there's going to be a lot of debt that's just kind of monetized and brushed under the
Yeah,
desk.
and
Right.
we'll get the story from the Chinese Communist Party's propaganda office that will tell us what the story really is.
Yeah. Yeah. But
Story of it.
yeah, it'll be fascinating. And the knock-on effect for me is, how does that impact FDI into the country? So. But it's still a lot of chapters left, I think, on that one, and obviously whether or not there is that going to be that contagion issue that we see really rattle global markets, because we do know global markets on the real estate front are definitely pretty closely intertwined. So, all right, Brett. Well, that is our last slide, and that brings us to the end of this sentiment and flow show. So, I guess my biggest takeaway is that overall things remain pretty solid ground. There's certainly plenty of headwinds and headlines in the market that could chop us down, creating volatility. But you got your fiscal headlines, monetary policy headlines, expecting a weak Q3 earnings season coming up. But I think most of the stuff that we're seeing that's impacting everything is manageable. Some is politically driven, others is just a matter of trying to catch up with demand, which hopefully we could do before the supply chain disruptions knock off that demand and the expectations for people buying. But I do expect to see continued chop going on over the next couple of weeks. We've seen that in the volatility around the AAII sentiment. And right now, I'm pretty impressed with this rally, but I'm a little skeptical of it near term, as I do think that we're going to see plenty of cautious headlines crossing out of that earnings season. So going through, keeping my portfolio in shape, but prepared to trade to the downside here if I see any opportunity. What's your key takeaway from the environment right now, Brett?
My key takeaway is really that it's amazing how quickly people became very bearish. Even if it's not on a long-term basis, but some of the fund manager survey information suggests that it's even on a larger time frame, and it's easy to get malpositioned. Maybe they haven't done that step, but we certainly have seen shifts in terms of how people are behaving in this market in a way that's like there's a huge option skew, basically pricing up protection to levels that we didn't see since February 2018 after what I call the VIX explosion. where we had the inverse VIX ETFs go out of business. That type of hedging came in around this event and even ahead of it. So people were turning toward there's going to be some real problem of some kind. Maybe it's a seasonal kind of instinct in, mid-September, and from mid-September to mid-October seems to be, when we have pretty much all of the markets really bad days. Who knows? But it was interesting to see from this data how quickly people shifted to a very protected, conservative, and skeptical positioning framework and attitude around the market. And typically, if as long as something doesn't really go cockeyed, that's the type of thing that leads to a surprising full recovery. So it's difficult for me to fade this market, knowing how much hedging and how much pessimism so quickly built up around something that doesn't have to necessarily turn bad.
All right. Well, that's going to do it for us then, Brett. We kept it just under an hour, so we're getting a little bit better. We're trying to keep be as concise as possible, but we do want to get you all this information and get Brett's thoughts out there, as they are extremely helpful when you are trading and investing. So, Brett, as per usual, thank you very much for your time here. I'll be posting this shortly, and we'll be keeping an eye out on the markets this afternoon. So, Brett, you take care of yourself out there, and we'll talk to you soon.
You got it. Thanks very much, Gav.
All right, no problem.
Take care.
Okay. Everybody, we're going to just stop the stream for a quick second here. I will be posting the taped event 2 in play in a little to the trader page in a little bit, but you might need to refresh the browser. So I'll give you a heads up on that, but give me 5 minutes just to take care of the technical issues, and we should be back up and running and ready to go this afternoon.